Today, we're walking through 5 key steps to building a resilient, diversified portfolio that can help you stay calm, consistent, and confident no matter what the market does. The stock market is back up, and that's exactly when investors get overconfident. Because when markets are rising, everyone thinks they're diversified until the next downturn proves they're not. If your portfolio only works when markets are up, you don't actually have a strategy. Today, I'm showing you how to build a diversified portfolio that's designed to survive the next market drop before it happens. With the recent resurgence in the stock market, now is the perfect time to pause and take a hard look at your investments. Not because things are bad, but because things feel good. And historically, that's when investors take on more risk than they realize. Diversification isn't about maximizing returns in a good year. It's about managing risk so you can stay invested through the bad years. Market downturns aren't a question of if, they're a question of when. And if you're a long-term investor, diversification is not optional, it's essential. Before we talk about stocks, bonds, or funds, we need to talk about purpose. Every dollar you invest should have a job. Are you investing for retirement, saving for your child's college, planning to buy a home in 5 years, or building long-term wealth? Your goal determines your time horizon, and your time horizon determines how much risk you can reasonably take on. Generally speaking, the longer your timeline, the more market volatility you can tolerate. If retirement is 25 or 30 years away, short-term market drops matter a lot less. But if you're saving money you'll need in the next 2 or 3 years, that money does not belong in the stock market. In fact, short-term goals are often better served by high-yield savings accounts or other low-risk vehicles. You may not earn as much, but you're protecting the money you'll actually need pretty soon. One of the biggest investing mistakes people make is putting their short-term money into long-term investments and hoping the timing works out. Once your goals are clear, the next step is asset allocation. Asset allocation simply means deciding how much of your money goes into broad categories like stocks, bonds, cash. Think of these as your portfolio's main building blocks. Stocks tend to offer higher long-term returns, but with more volatility. Bonds typically provide stability and income, but lower returns. Cash offers safety and liquidity, but very little growth over time. The right mix depends on your risk tolerance and how long you plan to stay invested. Someone in their 30s and 40s with a long investment horizon might lean more heavily towards stocks. Someone approaching retirement may gradually shift toward bonds and cash to reduce volatility. This step alone explains a significant portion of your long-term investment results. In fact, studies show asset allocation matters far more than individual stock selection. This is also where working with a certified financial planner professional can add real value, helping you choose an allocation that matches both your financial plan and your emotional tolerance for risk. Here's where many investors get tripped up. Owning stocks doesn't automatically mean you're diversified. If all your stocks are in the same sector, in the same country, or the same type of company, you're still exposed to concentrated risk. Within equities, diversification means spreading investments across different industries, sectors, company sizes, and geographic regions. Technology, healthcare, energy, financials, they all perform differently depending on economic conditions. US stocks, international stocks, and emerging markets don't always move in the same direction at the same time. The same principle applies to bonds. You can diversify across government bonds, corporate bonds, municipal bonds. You can vary maturities, credit quality, and interest sensitivity. Each behaves differently when interest rates change or the economy slows down. Yes, the numbers of available asset classes can feel overwhelming. The goal isn't to own everything, it's to own investments that complement each other and align with your risk tolerance. Once you've decided on your asset allocation and asset classes, it's time to choose the actual investments. This is where simplicity wins. You do not need to be a stock picker to be a successful investor. Exchange traded funds or ETFs and mutual funds allow you to gain exposure to entire markets or asset classes with a single investment. One fund can hold hundreds, even thousands of securities, instantly increasing your diversification and reducing the risk tied to any single company. These vehicles often make portfolio management easier, more cost-effective, and less emotionally driven. Instead of constantly reaching to headlines, you're investing in long-term trends and broad market growth. Over time, your portfolio will drift. If stocks perform well, they'll start to make up a larger portion of your portfolio than you originally intended. Rebalancing means periodically bringing your portfolio back to its target allocation. This might mean selling some of what's done well and reallocating into areas that have lagged. It's not about timing the market, it's about managing risk. Rebalancing helps overexposure to assets that may be overvalued and reinforces disciplined investing behavior. Many investors skip this step, but it's one of the most important parts of maintaining diversification over time. Markets change, economies shift, life happens. Your portfolio should evolve as your goals, income, and risk tolerance change. Regular reviews help ensure your strategy stays aligned with your reality. Diversification is the cornerstone of long-term investing success. By spreading your investments across asset classes, industries, regions, you reduce the risk and increase the likelihood of staying invested through all market cycles. It takes planning, monitoring, and rebalancing, but when done correctly, diversification gives you something incredibly valuable: peace of mind. If this video helped you, hit like, subscribe, and share with someone who needs to hear this before the next market downturn. I'll see you in the next one.